Welcome to Breaking News to Trading Moves. If you just glanced at the broad indices lately, you'd probably be forgiven for thinking that the U.S. markets were just treading water, pretty flat overall.
Yeah, on the surface, not a lot of action.
But those headline numbers, they really hide a much more active story underneath. So our goal here is to just ignore that market noise and zoom in on two opposing forces that were really driving things.
And we found them.
We found very clear winners
Right.
and, well, very clear losers.
Exactly. When you break it all down, the positioning for traders showed a really stark preference.
Okay.
On one side, you saw strength in businesses focused on, well, two things: value for the consumer and discipline in their own spending.
So the lean and mean.
That's it. Lean, value-focused retailers and some of the big tech names that got smart about their margins. And on the other side, the selling side, we saw clear nervousness. This was in sectors facing structural challenges,
Like what?
squeezed groceries, for one, and then some of the high-priced AI infrastructure software, where valuations are stretched.
Right.
And finally, some of the challenged chip makers still dealing with a lot of complexity. This divergence, it's not random. It tells you where investors are rewarding certainty and punishing complexity right now.
Okay, let's start with the good news then. The sectors and companies that really demonstrated some upward momentum. And I think there's no better place to start than with the discount retailers.
Absolutely.
We're talking about companies like Dollar General, ticker DG, and its peer, Dollar Tree, DLTR. What was the mechanism here? What was driving that strength?
It was entirely tied to sentiment, but it was sentiment that was fueled by cold, hard numbers.
Right.
Dollar General DG was really the catalyst. It jumped after reporting very strong earnings and then followed that up with an upbeat forecast, their guidance.
And that confirmed a theory, right?
It did. It basically validated this crucial market idea that when cash gets tight, shoppers don't just stop buying things like household goods or food.
No.
Instead, they just shift where they buy them. They're trading down to the dollar stores to find value.
So that average consumer who might have gone to a big grocery store before for snacks or cleaning supplies is now making a specific trip to the dollar store instead.
Precisely. We see this a lot when inflation hits basic goods. The consumer is budget conscious, not, desperate. They're just demanding value.
And because DG confirmed this was happening?
Right, because they confirmed this trade-down effect was real and was helping their bottom line, that positive feeling just immediately lifted their competitor, Dollar Tree, DLTR as well.
Because they operate on the same principle.
Exactly. The market assumes they're benefiting from the same behavioral change. It's a very clean win for the value end of retail.
That's a compelling story. Value wins when the budget is tight. Okay, so moving from value discipline in stores to margin discipline in the virtual world, we saw strength in social media and digital ad platforms. Here we're looking at Meta, ticker META, and of course Google, GOGL.
The two giants.
We often see them move together since they shared that digital ad space. But META had something specific driving it this time. What was that?
Yeah, META got a real boost from reports about a calculated strategic change. For years, they poured billions into those metaverse projects.
Billions.
The news suggested they plan to cut that spending way back and pivot those resources toward areas with quicker returns.
And those areas would be?
Their core business, advertising, and using artificial intelligence to make that ad business better, not just for some future concept.
So for the market, that just signals discipline.
Total margin discipline. Moving capital away from speculative, costly projects like the metaverse and into proven moneymakers is seen as a direct positive for their profitability right now.
So it's a story of just trimming the fat and focusing on what works today.
It is. The market loves efficiency, and META showed they're listening to investors who want better margin control. And when META shows that kind of strength, it tends to cast a glow over the whole ecosystem.
Benefiting peers like GOGL.
Yeah. The assumption is if META's core ad business is getting healthier, then the digital ad market as a whole must be pretty robust.
Okay, perfect. So value and discipline are in the winners column. Let's touch on a different kind of winner. The sectors people use as sort of insurance against volatility and inflation.
The classic hedges.
Right. I'm talking about energy and gold plays, specifically ExxonMobil, ticker XOM, and the big gold miner Newmont, ticker NEM.
Yeah.
What was going on in the macro environment to lift these two?
This one is pretty fundamental. We saw the prices of both oil and gold move higher at the same time.
Okay.
And that rising commodity environment just acts as a tailwind for the companies that sit on top of all those reserves.
Yeah.
For an integrated major like XOM.
And integrated means they do everything from drilling to the gas station.
Exactly. Upstream and downstream. So for them, higher oil prices mean their main asset is just worth more. They can lock in better margins everywhere.
And the gold play, Newmont, NEM, that's just a pure safety move, isn't it?
Absolutely. Gold is a classic safe haven asset. When traders see rising volatility or they have concerns about the purchasing power of, standard money,
They run to hard assets.
they look to hard assets like gold. A higher gold price directly helps miners like NEM, making them attractive for investors trying to protect their capital. So the winner circle is pretty well defined: value, discipline, and defensive plays.
All right, now let's flip the conversation and look at the sectors that saw some real selling pressure during the same period. This is where, I guess, the cost of complexity and the pain of competition really show up.
For sure.
First up, grocery retailers. The traditional players, the bigger supermarkets. We're setting Kroger, ticker KR, and Albertsons, ticker ACI. Why were these big established chains under so much pressure?
Well, you can draw a straight line right back to our first segment.
The dollar stores.
Yep, Kroger KR. It slid after they reported disappointing performance.
Yeah.
They specifically missed on their sales expectations, and that was the immediate negative catalyst.
And that miss raised a bunch of concerns.
It did. It immediately made the market worried about two things. One, intensifying competition from the discounters we just talked about, and two, the margin pressure that comes with that.
So if customers are going to Dollar General instead, that hurts Kroger's sales.
That's the top line hit.
And if Kroger has to cut its own prices to compete, that hurts their profitability. It's a double whammy then.
Precisely. And the market hates uncertainty about margin compression. So that worry about the consumer trade-down dynamic just immediately weighed on other large grocers, which is why you saw selling pressure on Albertsons ACI as well.
One bad report sends a chill through the whole aisle.
A classic case of it, yes.
Okay, moving on from physical retail, let's look at the high-growth software and data space where a premium valuation is just part of the game. We saw setbacks for cloud data companies like Snowflake, ticker SNOW, and Datadog, DDOG.
Right, both very highly valued.
So what was the issue that spooked the market here? Was it, like you said before, about complexity?
Yeah.
Or the cost of the future?
You just hit the nail on the head. It was about the cost of the future crashing into what people expect today. Snowflake, SNOW, it dropped sharply after they provided a disappointing outlook, specifically on their operating margins.
And why were margins getting squeezed?
The company said it was due to the heavy, immediate investment needed to build out their AI capabilities. And while AI is a powerful long-term growth driver,
It's expensive now.
it's very expensive now. That upfront investment is expected to pressure their near-term profitability pretty severely.
So they're paying for tomorrow's growth today, and the market is not happy about the immediate bill.
But that's exactly it. This is what we call the high multiple penalty. When a company like SNOW is valued on the assumption of rapid, perfect execution, any downward revision,
Even if it's for a good reason, like investing.
right, even then, it can trigger an exaggerated sell-off. And that negative outlook dragged down sentiment for other high multiple data names like Datadog, DDOG. They became sort of collateral damage.
Wow, okay. That is a harsh pressure. Finally, let's look at the challenges for some of the older PC-linked semiconductor companies. We're talking about legacy chip makers, specifically Intel, INTC, and AMD. Intel has been trying to manage this complex turnaround for years, trying to get leaner. What happened this time to cause more downward pressure?
The pressure on Intel INTC came from reports that the company decided it would retain its networking and communications unit.
And the market wanted them to sell it.
That's what Wall Street was hoping for, yeah. That INTC would streamline, sell off non-core assets, and just focus all its capital on its main manufacturing business.
But they didn't.
They didn't. And retaining that unit just maintained all the existing concerns about the complexity of the turnaround and, crucially, the high capital intensity required. They didn't trim the fat when investors thought they would.
That sounds like an Intel-specific problem, but you mentioned AMD, ticker AMD. Why did it affect them?
Because the Intel decision just reinforced these broader industry concerns. The high capital intensity that Intel faces, the enormous amount of money needed to build and upgrade chip plants, that's a sector-wide issue.
Not just an Intel problem.
No.
Right.
So when INTC signals it's having trouble simplifying its structure, it just highlights the operational difficulty and cost for the entire legacy chip industry. That complexity then weighed on other PC-linked names, including AMD, because of that shared operational headache.
So if we step back and summarize the overall flow here, it really is a story of focus and value. The market is favoring companies that are prioritizing value for the customer and margin discipline internally.
Right. The lean retailers and the disciplined big tech.
And conversely, it's punishing complexity and these structural challenges. So that means selling pressure on squeezed groceries, expensive AI plays that disappoint on short-term margins.
And the challenged chip makers who are struggling with those high capital demands. And here's a thought for you to consider as you reflect on all this. Given that confirmed trend of shoppers trading down to discount retailers, how might the traditional higher-cost, big-box retailers adjust their product sourcing and inventory management in the coming quarters to regain that market share?
Tough question.
It requires a strategic and, well, often painful answer to the consumer's unrelenting demand for value.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.